picture this. It's feudal Japan, right?
Yeah.
Centuries ago.
Mm-hmm.
And you were standing right in the middle of the Dojima Rice Exchange in Osaka. The air is just, thick with shouting, and there's frantic hand signals everywhere, and just this intense, chaotic energy of merchants trading rice futures.
Yeah, it's total chaos.
Exactly. And among them is this legendary merchant, Homamune Hisa, and he's quietly making this massive realization that is honestly going to change financial history forever.
Oh, without a doubt, it was revolutionary.
Right, because he looks around and realizes that, sure, raw supply and demand, they absolutely set the fundamental price of a bag of rice. But the actual moment-to-moment movement of that price, where it goes next, that is driven entirely by human emotion. Fear, greed, hope, panic, all of it.
It's basically the ultimate behavioral economics laboratory, right? And this is happening hundreds of years before we even had a term for the field.
Yeah, exactly.
Hama understood that while Western financial thinkers would eventually get completely obsessed over strict mathematical indicators and closing prices, you really cannot ignore the emotional temperature of the people who are actually doing the buying and selling.
Fast forward to today. I mean, look at your phone right now. You pull up a brokerage app, and it is just a blur of flashing numbers. Jagged red and green lines, relentless data.
It's exhausting.
It really is. It just feels like exhausting noise. So how are you supposed to see the human emotion driving those numbers?
Yeah.
And I guess that brings us to the mission of today's deep dive.
Yes, exactly.
We are exploring Steve Nison's truly groundbreaking book, Beyond Candlesticks. New Japanese charting techniques revealed.
Such an incredibly important piece of work.
It really is. I mean, Nison originally brought basic Japanese candlestick charting to the West back in the late 80s, but the specific source material goes much, much deeper into these highly sophisticated, long secret methods.
Yeah.
And our goal today is to show you how to filter out that modern market noise and actually see the pure underlying psychology of price movement.
Because whether you are, an active trader moving capital around, or you're simply someone who's fascinated by human behavioral data and crowd decision-making.
Which is fascinating on its own.
Oh, totally. Learning to combine these different analytical perspectives, it creates this dual action analytical framework. It completely shifts how you view data, how you assess risk, and honestly, how you interpret human action.
Think of it through a lens analogy, right? Western technical analysis, so things like your standard trend lines or moving averages, that is your wide-angle drone shot of a battlefield.
You see the big picture.
Exactly. You see the terrain, you see the broad, sweeping movements of the armies. But Eastern candlestick charting is a microscopic, high-definition camera zooming right in on the immediate hand-to-hand combat between buyers and sellers.
I love that analogy because Western tools and Eastern techniques, they aren't opposing philosophies at all. They are complementary lenses looking at the exact same reality. But to truly understand how to zoom out and use that drone shot effectively, we first have to master that micro-level hand-to-hand combat.
Yeah, we have to start small.
Exactly. We have to look at the advanced candlestick patterns Nison reveals because they show us the immediate psychological state of the market participants.
Because before you can read the broader market, you have to read the micro-emotions of the people in it. So let's start with one of the most potent patterns Nison talks about, which is called the window.
Ah, yes. The window.
Now, in Western terms, we literally just call this a price gap. It's simply an empty space on a chart where the price jumped up or down violently between sessions, and absolutely no trading happened in between those two price points.
But the Japanese interpret that empty space entirely differently. In their theory, a window is considered one of the most powerful continuation signals in existence. The golden rule they use is simple but absolute. The market always moves in the direction of the window.
Okay, let's unpack this for a second, because a window is literally just a blank space on a chart.
Right.
It is a void where zero transactions took place. How can nothingness act as a physical barrier of support or resistance?
Yeah.
That just sounds completely counterintuitive.
Well, what's fascinating here is that the void isn't actually nothing. That empty space represents a massive psychological shock to the system.
Okay, how so?
So imagine a stock closes at $10 on Friday. Over the weekend, incredible news breaks. On Monday morning, the market opens and the stock immediately starts trading at $15.
Wow.
Right. It leaped so violently that it left a literal $5 gap on the chart. That demonstrates immense, overwhelming buying pressure. But think about the psychology of the people watching that
I
happen.
mean, every trader who sold at $10 is waking up absolutely sick to their stomach.
Precisely. That empty space is filled with their psychological regret.
Oh, wow. I never thought of it like that.
Yeah, so that void becomes a massive support zone on future pullbacks. If the price ever drifts back down towards, say, $12 or $11, those people who missed out on the initial explosion are frantically waiting there to buy in, trying to correct their mistake.
They just want a second chance.
Exactly. And unless the price falls and closes entirely below the window's lower boundary, meaning all those eager buyers have been completely overpowered, that uptrend is structurally intact.
So it's basically a psychological scar on the chart, showing exactly where the buyers completely overwhelmed the sellers.
That's a perfect way to put it.
And Nison also highlights these incredible multi-candle reversal patterns that track shifting momentum, right, like the evening star.
Yes.
It happens at the top of a long bull trend. You get a large white candle, meaning buyers are clearly in control. Then a small-bodied candle that gaps up above the first one. And finally, a plunging black candle that wipes out the progress of that first white candle.
The evening star is a beautiful, if terrifying, sequence. It represents a complete, orderly, emotional handover of power. Think of a local real estate frenzy.
Okay.
The buyers are aggressively bidding up prices. That's your large white candle.
Right.
The small gapping candle in the middle, that's the hesitation. It's the moment buyers realize they're out of breath. Maybe interest rates ticked up a bit, and the bidding wars just pause.
Like holding their breath.
Yes. And then that plunging black candle is the aggressive sellers seizing control of a suddenly terrified market. And, Nison also talks about slower variations of this emotional shift, like the dumpling top and the fry pan bottom.
Okay, I have to say, the names make them sound like items on a breakfast menu. It almost makes it hard to take them seriously as financial indicators.
I know. The names are definitely quirky. But structurally, you really have to think about what a frying pan actually does. It doesn't flash fry right. It heats up slowly and evenly. Instead of a violent three-candle reversal like the evening star, a fry pan bottom shows a gradual multi-week shift in candle color and size.
Oh, I see.
Yeah, the selling pressure slowly simmers down, the market chops sideways at the bottom of the pan, and then buying pressure slowly begins to boil over. It's a slow burn of emotion rather than a violent explosion.
Okay, so individual candles and these small clusters, they show us that immediate, visceral, emotional battle. But, I mean, if I am staring at every single 5-minute or hourly candle, I am going to get completely overwhelmed.
Oh, absolutely.
There is just so much distracting daily noise. So how do we filter that out without losing the psychological thread?
Well, the Japanese did something totally radical to solve that exact problem. To find pure trend strength, they completely discarded the concept of time.
Discarded time. Wait, what?
Yeah. In the West, we are obsessed with time-based charts. A new data point forms every hour or every day, regardless of whether the price actually moved in a meaningful way. But the Japanese developed Renko charts. The word actually comes from renga, which translates to brick.
Okay, so you set a fixed brick size for the asset, let's say $1. A new white brick is only drawn if the price moves up by a full dollar from the top of the previous brick.
Right, exactly.
And a black brick is only drawn if it drops a full dollar from the bottom. So if the price just chops around in a tight, like 90-cent range, the chart remains completely frozen.
Yes.
It doesn't matter if it takes 10 minutes or 3 days. No new bricks are drawn.
And by doing that, it completely eliminates market noise. You aren't seeing the false breakouts or the intraday volatility that shakes people out of perfectly good positions. A structural trend change is simply a black brick followed by a white brick.
But hold on, isn't that inherently dangerous? I mean, if the chart is frozen for 3 days because the price hasn't moved a full dollar, you could be missing underlying fundamental shifts happening in the real world. Like, a CEO could resign, or a geopolitical event could happen, and your chart is just sitting there doing nothing.
I get that. It feels really uncomfortable at first because we are so conditioned to watch the ticking clock, but think of a Renko chart, like a highlight reel of a sports game.
Oh, I like that.
You don't want to watch the players standing around during timeouts, pacing the sidelines while the clock just runs down.
Yeah, that's boring. You just want the action.
You only care about the moments when someone actually scores points. If a CEO resigns and it genuinely matters to the value of the company, the price will move that dollar and the brick will draw.
Right.
If the price doesn't move, then the market has decided the news is just noise. Renko forces you to ignore the narrative and focus purely on verified objective momentum.
That is a phenomenal way to frame it. But Renko only captures momentum in a straight line. What if we want to track shifting power dynamics and find out where the big institutional money is hiding? Does the text offer a tool for that?
It does, through a technique called Kagi charts, which actually originated back in the 1870s.
Wow, that's old.
Yeah, and Kagi charts look completely different from standard graphs. Instead of bricks or candles, it is a single, continuous vertical line that steps up and down.
Just one line.
Just one line. And the genius part is how it alternates thickness, using the concept of yin and yang. A thin, delicate yin line represents bearish market control. A thick, bold yang line represents bullish market dominance.
So how does the algorithm know when to switch from thin to thick?
It switches based on structural breakthroughs.
Oh.
A thin yin line turns into a thick yang line the exact moment the rising price breaks above the previous swing high, what the Japanese call the shoulder of the chart. That immediate change from thin to thick is an objective signal that buyers have taken total control. Conversely, if a thick yang line drops below the previous swing low, which they call the waist of the chart, it turns into a thin yin line.
And Nison points out that institutional capital actually defends those shoulders and waists. But why is that? I mean, why do those specific invisible lines matter so much to massive hedge funds?
Because institutional trading is largely algorithmic, and those algorithms are programmed to recognize clear liquidity pools.
I see.
Yeah, the shoulders and waists on a Kagi chart represent objective historical points where the market previously pivoted. Institutions know that retail traders place their stop-loss orders just above or below those levels.
Right, because that's what everyone is taught to do.
Exactly. So defending those levels or attacking them becomes a self-fulfilling prophecy. Kagi visually maps out the battle lines of where the big money is forced to step in.
This brings us to a third non-time-based technique, the three-line break chart. This one is famous for giving crystal clear trend identification. It's drawn as a series of vertical white and black blocks. But unlike Renko, where the brick size is fixed at a specific dollar amount, the height of the three-line break blocks depends on the actual price distance the market moved.
Right, and the secret sauce here is the reversal rule. Let's say you are in an uptrend, looking at a staircase of white blocks.
Okay.
To break that uptrend and draw a new downward black block, the price can't just dip a little bit. It must drop and close below the combined lowest point of the three most recent white blocks.
Wow. So it has to break through the extremes of three entire prior upward pushes just to register a reversal.
Exactly. It acts as a natural self-adjusting trend filter. If the market drops but doesn't have the kinetic energy to take out the lows of those past three blocks combined, the core uptrend is totally intact. You just stay aligned with the primary wave and ignore the minor corrections.
Man, we have these incredible Japanese tools. We can discard time to see pure movement, and we can read the micro emotions using candlesticks. But Nison makes a huge point here, right? He says you should never use these tools in a vacuum. A signal is only as good as the context it appears in.
Oh, absolutely. This is the central tenet of the entire philosophy. It's the symphony of East meets West. The Eastern candles tell you when to enter a trade based on immediate emotional shifts. But Western tools tell you where to enter.
Right, so if you see a bullish engulfing pattern where a big white candle completely swallows the previous black candle, showing a sudden surge in buying, if that happens in the middle of a random, sideways, choppy market, who cares? The context is weak.
Exactly. But if that exact same bullish engulfing pattern forms precisely at a major historical support floor, or say a 50% Fibonacci retracement level, which is a mathematical baseline Western algorithmic traders use to find natural pullback areas, the probability of an explosive upward move skyrockets. Nison calls this confluence. It's when two totally independent analytical methodologies arrive at the exact same conclusion at the exact same time.
Okay, here is where it gets really interesting, and I have to push back a little.
Sure.
What about when the market just goes totally parabolic? The price is skyrocketing, breaking all the resistance ceilings. Isn't that extreme bullishness exactly what we want? Why does Nison warn that parabolic moves are inherently dangerous?
That's a great question. We have to look at how Japanese traders uniquely use moving averages to understand why parabolic moves are actually traps. In the West, a moving average is just a smoothing line, to show the general trend direction.
Right, basic stuff.
But the Japanese use a tool called the moving average disparity, or the disparity index. It measures the exact percentage distance between the current price and its moving average baseline.
Okay, so it essentially measures how far the price has run away from its home base.
Exactly. The text uses the brilliant analogy of a stretched rubber band.
Oh, I love that.
The moving average is the center point. Extreme positive or negative readings on the disparity index mean the market is severely overextended.
Right.
So if the market is rocketing upward parabolically, that rubber band is stretching further and further. If you suddenly see an eastern reversal signal like a shooting star candle, which has a tiny body at the bottom and a massive long wick shooting up like a falling star, showing buyers got completely rejected at the top,
Yeah.
and it perfectly coincides with an extreme positive disparity reading, that is a massive warning. The rubber band is about to snap back violently toward the moving average baseline.
The visual of the rubber band snapping back against the buyer's hand is just incredibly clear. And the fuel stretching that rubber band is volume, right? Nison stresses that volume is the energy behind the candle.
He does. Volume is the underlying conviction of the crowd. A breakout above a resistance line on low volume is a trap. It means the big institutional players aren't backing the move. It's just retail traders getting overly excited.
Makes sense.
Conversely, in a healthy bull market, volume should mathematically shrink during those minor red candlestick pullbacks. That light volume proves the sellers lack conviction. They're taking quick profits, not initiating a mass exodus.
Okay, so we've got Confluence, we've got the disparity index, we're filtering noise.
Yeah.
But let's be real, even with all this psychological insight, the market is a chaotic system that can still completely prove you wrong. If you don't have a safety net, none of these ancient secrets will save your capital.
Oh, totally. Risk management is the non-negotiable foundation of this entire system. Nison provides very rigid mathematical rules for protective stop placement to take emotion completely out of your exit strategy.
Okay, so let's walk through the mechanics of one. So you buy an asset based on a hammer candle.
Okay.
This is a candle with a small body at the top and a long plunging wick at the bottom, which clearly shows that sellers tried to push the price down, but buyers rejected those lower prices and hammered the market back up. Where does the absolute stop loss go?
It must go slightly below the absolute lowest tip of that hammer's wick.
Why there specifically?
Think about the mechanism of what that wick actually represents. It is the exact empirical coordinate where sellers attempted to break the market and failed. If the price later drops down and closes below that wick, the fundamental mechanics of the market have shifted. It proves your premise for being in the trade was objectively wrong.
Wow. So there is no room for emotional bargaining. You can't sit there saying, oh, it'll bounce back tomorrow.
You exit immediately because the psychological barrier you relied on has shattered.
So what does this all mean? If I am sitting at my desk Monday morning, looking at an overwhelming barrage of charts, how do I actually layer these tools together without going completely crazy? How do we synthesize this into Nison's 4-step master plan?
Well, it starts with establishing your macro bias. That's step one. You take your wide-angle drone shot, you check your Western support and resistance levels to map the terrain, and you look at a 3-line break chart. If the 3-line break is showing a solid stack of upward white blocks, your overall bias for the week is strictly bullish. You are only looking for reasons to buy.
Okay, got it. Then step 2 would be filtering the intraday noise. So I switch over to a Renko chart. I'm looking for clean, consecutive white breaks to verify that the upward momentum is steady, totally ignoring whatever random 5-minute volatility is happening in the news cycle.
Exactly. And then step 3 requires patience. You go back to your traditional candlestick chart, the microscopic camera, and you wait for a minor pullback that lands perfectly on one of those Western support floors you mapped out in step 1.
Right.
You wait for the exact moment where value meets opportunity.
And the final step is execution. The price drifts down to that support floor. Suddenly, a hammer candlestick forms right on that line, and the volume spikes, showing real conviction. I check the disparity index, and it shows the rubber band is oversold, stretched down, and ready to snap up. I enter the trade. I set my rigid stop loss just below that hammer's wick to protect my downside, and I target the next window gap overhead to take my profit.
Perfect. You've just harmonized the macro context, the noise-filtered trend, and the precise psychological trigger. You aren't gambling anymore. You are executing a systematic approach that prevents rash, emotion-driven decisions.
That really is the core realization of Beyond Candlesticks, isn't it? Prices aren't just abstract numbers floating on a screen. They are the real-time manifestation of human psychology, liquidity, and emotional energy.
Absolutely. Whether you are reading the hesitation in a doji candle, where the opening and closing prices are completely tied,
Yeah.
showing total market indecision, or observing the thick yang line of a Kagi chart showing algorithmic dominance, mastering these tools gives you unparalleled clarity in any market condition.
For you, the listener, whether you are analyzing financial markets, real estate trends, or honestly any other complex system driven by human behavior, the takeaway is pretty clear. Taking these multiple complementary perspectives, combining the wide-angle drone shot with the micro-level camera, is the ultimate key to mastering an overwhelming influx of information.
This raises an important question, though, completely outside of finance.
Oh,
Yeah, Nison's non-time-based charts completely ignore the clock to reveal pure, unadulterated movement, right?
right.
So, if price is just human psychology manifesting on a screen, what would happen if you applied this Renko philosophy to your own life?
Oh, wow. That is a fascinating pivot. How would that work?
Think about the noise we deal with daily. What if you stopped measuring your personal progress, your habit building, or your professional work by the hours ticking away on a clock?
Like just sitting at a desk.
Exactly. Sitting at a desk for 8 hours is just time passing. It doesn't mean you actually moved forward. What if you only measured the actual fixed bricks of pure forward movement?
Oh, I see. A completed project.
A completed project, a finished chapter, a tangible milestone. How much daily noise, anxiety, and sideways chop would you instantly filter out of your own life?
That is incredible. Stop stressing over the timeouts and focus purely on the points on the board. I love that. We want to thank you so much for joining us on this deep dive. As you go through your week, remember to look for the psychological windows and the objective bricks in the data around you. Until next time, keep zooming out and keep your eyes on the real hand-to-hand combat happening right beneath the surface.